Supermicro stock is trading right now at $28.48 per share, marking an intraday gain of 2.70% or 75 cents off its previous closing mark of $27.73. During today's session on August 3, 2026, shares have moved between a low of $27.21 and an upper boundary of $29.30 on steady trading volume exceeding 35 million shares. At first glance, seeing a green session might lead retail investors to believe that the severe volatility surrounding high-density server equipment suppliers has finally smoothed out. The common expectation on Wall Street is that as long as hyperscale tech titans keep spending billions on artificial intelligence infrastructure, rack assembly partners like Supermicro will automatically capture high-margin cash flow. The reality hidden beneath the ticker, however, is far more complex and demanding. While top-line demand for server architecture remains massive, Supermicro finds itself caught in an intense pricing squeeze where revenue expansion no longer guarantees bottom-line expansion. Investors glancing at their individual brokerage account or watching ticker updates across popular investing sites might see steady daily volume, but institutional desk flows reveal a tug-of-war over structural profit margins. Retail traders opening their Robinhood app or browsing Robinhood stock trading channels often treat Supermicro as a leveraged proxy play on GPU manufacturers, yet operational mechanics tell a different story. Unlike chip makers who command massive pricing power, server builders operate on far tighter gross margins, where component costs, direct liquid cooling integration, and customer concentration dictate survival. When you look at broader tech allocations across retail portfolios, comparison becomes inevitable. On platforms where traders track Tesla stock, Apple stock, or NVIDIA stock, the expectation is that hardware providers tied to next-generation computing infrastructure will experience compounding earnings growth. Yet, over the last several quarters, Supermicro's gross margins have contracted, shifting from mid-teen percentages down toward single-digit ranges under intense competition. Institutional managers utilizing Interactive Brokers platform tools and Interactive Brokers trading algorithms have noticed this divergence between unit volume growth and dollar profitability. While order books for rack-scale liquid-cooled servers remain filled, the cost of securing scarce components combined with aggressive pricing tactics from legacy competitors has capped operating profits. To understand why shares are swinging wildly within a 52-week range that spans from under $20 to nearly $60, one has to examine how retail platforms handle high-beta hardware stocks. Millions of individual investors using the Robinhood app for Robinhood investments or Robinhood cash management services see Supermicro listed among top daily volume leaders. Similarly, users exploring Robinhood fractional shares or turning to SoFi Invest for SoFi active investing frequently allocate capital toward hardware suppliers expecting quick turnarounds. When market participants log into their Fidelity trading platform or manage long-term wealth through Fidelity Investments, Fidelity Mutual Funds, or Fidelity IRAs, the focus often shifts toward stability, cash flow durability, and balance sheet transparency. Supermicro sits right at the intersection of these two distinct investor mindsets: the high-velocity active trader seeking short-term momentum and the cautious institutional allocator demanding steady accounting metrics. Let's establish what mainstream market commentaries are missing about recent price action. The broad narrative claims that any pullbacks in server manufacturing stocks stem solely from temporary supply chain delays, but looking closer at order fulfillment cycles and capital deployment across enterprise data centers reveals that customer bargaining power has shifted dramatically. Major cloud service providers are playing server assembly partners against one another to drive down unit costs. costs. So while Supermicro Computer maintains an early mover edge in custom direct liquid cooling systems, a vital technology required to keep ultra-dense GPU racks operating without thermal throttling, that technical edge is constantly being eroded by competitive bidding. Traders accessing investment help through Schwab Intelligent Portfolios or setting up automated strategies via an intelligent portfolio mechanism must recognize that hardware assembly does not possess the software-like economic moats that many assume. If you are following this company closely and trying to determine how it fits into your broader portfolio strategy, drop a comment below letting us know how many shares of Supermicro Computer you currently hold and what price target you are watching. Looking at how everyday retail capital flows into this ticker provides additional perspective. Investors utilizing SoFi for SoFi investing, SoFi stocks, SoFi ETFs, or using the SoFi Robo-Advisor platform pair hardware holdings with broader index exposure to offset single stock volatility. Meanwhile, active day traders using Interactive Broker's account features take advantage of Interactive Broker's fee structure to scalp intraday swings between support at $27 and resistance near $30. When market volatility picks up, self-investing retail participants searching for online investment tools or trying to invest online turn to platforms that offer real-time execution. Whether using a Fidelity mobile app to adjust a Fidelity brokerage balance, managing a Fidelity wealth management portfolio, or executing orders via a Robinhood crypto and equity account, the underlying concern remains identical. Can Supermicro Computer regain margin strength before customer capital expenditure cycles cool down? To fully grasp today's position, we must look at what the business actually does and how its legacy model evolved. Founded decades ago in Silicon Valley, Supermicro Computer built its reputation on modular, open architecture server design. Instead of selling rigid, pre-configured server boxes, the company developed a building block architecture that allowed corporate clients, research labs, and data centers to customize motherboard layouts, power supplies, storage enclosures, and cooling setups. As compute requirements shifted heavily toward hardware-accelerated workloads, Supermicro Computer moved quickly to integrate high-density power distribution and liquid cooling modules directly into enterprise server racks. Their close proximity to major semiconductor design firms allowed them to bring customized server solutions to market weeks or months faster than traditional enterprise suppliers. This speed-to-market model created extraordinary revenue expansion during the initial build-out of AI-focused data centers. However, rapid growth brought its own structural challenges. Managing complex inventory cycles, securing massive working capital lines to purchase expensive components, and maintaining rigorous internal financial reporting standards created operational friction. A corporate timeline marked by rapid scaling, stock split execution, and intense regulatory scrutiny altered market perception. Investors who once viewed the firm as a quiet, steady server maker suddenly found themselves holding one of the most volatile tech equities on the Nasdaq. That historical tension continues to influence trading behavior today as institutional investors weigh historical operational hurdles against current market demand. When evaluating current macroeconomic pressures, interest rates and corporate enterprise budgets play an outsized role. Higher borrowing costs make inventory financing more expensive for server builders who must purchase hardware up front before client delivery and payment reconciliation. When traders check their online investing dashboards or consult investing sites for real-time market data, macro headlines often obscure these cash conversion cycle reality checks. A sudden shift in corporate IT spending can lead to inventory buildups, forcing server assembly firms to discount products to maintain cash flow. That dynamic explains why trading volume routinely spikes on minor news updates as institutional desks recalculate fair value models based on fresh margin assumptions. As we look toward the upcoming quarters, the expectation versus reality framework remains the central lens for judging where Supermicro Computer is headed. Market expectation assumes that as global demand for compute power grows, every link in the server assembly chain will enjoy rising valuation multiples. The reality is that valuation multiples inevitably reflect gross margin sustainability, free cash flow generation, and corporate governance clarity. If Supermicro Computer can demonstrate sustained gross margin expansion while maintaining its speed-to-market advantage in liquid cooling, the gap between investor expectation and financial reality will close in favor of long-term bulls. Conversely, if price competition among server builders intensifies and component costs remain elevated, revenue gains may fail to translate into meaningful net income expansion. Navigating this stock requires looking beyond daily price spikes or social media sentiment loops. Whether you execute trades through an individual brokerage account, rely on interactive brokers' stock trading tools, manage long-term retirement funds across Fidelity IRAs, or maintain an active portfolio on SoFi Invest, tracking operational discipline matters far more than tracking short-term headline hype. Supermicro Computer remains a central player in physical server deployment, but its stock performance will ultimately be dictated by its ability to protect profitability in an increasingly crowded manufacturing environment. By anchoring your analysis in financial facts, gross margin trajectories, and customer concentration dynamics, you can cut through the market noise and evaluate this high-volatility hardware provider with true analytical clarity. Disclaimer: